Let's get more perspective on this whole tariff business that's become a complete reality now. Robert Sockin, global economist at Citi, is joining in with some thoughts. Robert, great to have you this morning. Never a dull moment, right? And now it's real, 25% Canada, 25% Mexico, and 20% effective additional tariffs on China as well. The market is nervous. Do you have some models or estimates so that one can work with that if these tariff levels persist, if they're not rolled back, then what does it mean for inflation or growth in the U.S.?
Yeah, absolutely. It's a very uncertain time, especially with these tariffs looking like they're going to go into effect. But then there's a broader question: if they do, will they stay in effect, and for how long? The models that we've run have shown that of these tariffs, the economic damage is probably largest for Canada and Mexico, given the significant ties to the U.S. economy. But the U.S. is not immune from the negative effects of these tariffs. And you're looking at a world where if our trading partners retaliate, which seems very likely, we just saw some news saying that Canada has prepared a list of retaliatory measures, that the stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit, probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation. So it is that stagflationary effects that most people in the markets are worried about. So we'll see if they go on and if they stay on. But I think it's a difficult and dangerous balancing act, because the negative economic effects might be larger for some of our trading partners, but they're certainly negative for the U.S. As well.
Sorry, Robert, I missed the number. Could you just repeat the rough estimation right now for both inflation and GDP?
If our trading partners put on a sizable amount of retaliation, not one for one, but if they put on retaliatory measures, you're looking at U.S. real GDP that falls over a several quarter period by over 1 percentage point. And I would expect the spikes in U.S. inflation in the short term to be half a percentage point or higher. So you're talking about sizable negative stagflationary effects.
Yeah, absolutely. Robert, hi, good morning. I have two questions. How long these tariffs will be in effect, according to you? Your best guess, base case, as they call it. And second, are U.S. stock markets not as important to Trump as they were during his first term? Because, I mean, how much damage will he tolerate?
Yeah, and these are the key questions. And I think I'd start with your second question, because the framework I've had in my mind and we've thought of on our team at Citi is that we know from Trump's first term that he cares a lot about the performance of the economy and the performance of the stock market. And it seems that under fairly large tariff scenarios, the economy is challenged and the stock market is challenged. You know, our teams at Citi have done a lot of work on this front. So I think on that point, I would assume that the tolerance is fairly low, which brings us back to, I think, even if these tariffs go into effect, my assumption would be that they would not stay on for a durable period because of those negative economic effects that I mentioned and the negative effects to equity markets you're likely to see. So, my base case is still that these tariffs are being used as negotiating tactics to have countries work with Trump on other priorities. But there's a lot of uncertainty. Certainly, I do not expect the tariffs on Mexico or Canada to go into effect at all. If you had asked me a few weeks ago, now it looks likely they may go on for at least some time. So I think it's a very uncertain environment. But I'd be surprised if they'd stay on for a durable period. I think they are the prelude to a larger set of negotiations.
So some pullback of these tariffs actually will be good news, because it's not going to hurt just the U.S. economy. The globe as well becomes a very, very uncertain place. Hi, Robert. Welcome to the show. Thanks a lot for joining in. Well, over the last few months, we have agreed that India is on a firm footing. Growth is pretty okay out here. Our stock markets have pulled back a little bit, and we have relatively underperformed. But growth in the past quarter was better than the previous quarter. And from here on, growth should be okay. In addition to that, we have an RBI that's made one rate cut. And the optimism is there in the next couple of months, we get another one. How do you see the Indian markets as well as the economy shape up from here on? And Are you as bullish on the prospects here in India?
Yeah, great set of questions. And I think, we've highlighted many times on this program how India has been one of the best performing economies in emerging markets, but more broadly than that, in our forecast, we've been significantly surprised or impressed by the strength of the economy. And for this year, looking for a lot more of the same. So our forecast for Indian growth is roughly in line with last year's pace, which was very solid in the mid 6% range. We're looking for something similar. And as you also noted, some additional scope for further rate cuts from the RBI. So I think the economic backdrop is very favorable. But I would also highlight that these issues that we're talking about of tariffs and trade uncertainty could also come back to India. And, we've seen Trump discuss the potential for reciprocal tariffs with trading partners. And India at times has come into the president's sights in terms of countries to target. So I think broadly speaking, there's a very positive economic backdrop for India, but we also have to be paying attention to more broadly this risk and uncertainty around global trade and ultimately what the U.S. tariff policy is going to look like globally, but also vis-a-vis India.
Okay. By the way, just taking a moment to recap the pre-opening rates, which are now on our screens, 125 points lower on the Nifty, which means it's a 0.5% decline, which is not that bad. And I think it's the scenario that Nigel was talking about that's playing out because we've already fallen so much.
15%.
India has been leading the global equity world in the downward draft, the biggest underperforming market perhaps in the region this year. So therefore, we're not hit particularly hard this morning. And remember that our Commerce Minister is in the U.S. this week to negotiate a trade deal with the U.S. And if, fingers crossed, if everything goes well, then perhaps, India could see some kind of gains as other partners also, hold their parlays with the U.S. So we're in very, very interesting times. So not too bad, must say, for a morning like today. Mid-cap index, though, is down a lot more. It's down about 1% or so. So, Robert, what's the sense? What's the advice? As this plays out from the Fed's perspective, what do you think the next steps could be? Because we had a guest earlier from BlackRock who was saying that all this complicates the situation for the Fed, and maybe the Fed has less maneuvering room if you're looking at a stagflation kind of a situation in the U.S.
Yeah, absolutely. And I think that is the real challenge of the environment we're in now, that if you go back even a few weeks ago, the fundamentals, broadly speaking, the U.S. globally, all look solid going into this year. I think they're still on a solid footing. But what we're seeing now is that a lot of the noise coming out of the Trump administration, in particular with regard to tariffs, is creating a lot of economic uncertainty. And you're starting to see that move into a lot of the economic data. You're seeing, for example, in the U.S., confidence measures come down. You're seeing inflation expectation measures generally creep up. And you're seeing a lot of noise in some of the survey data, some of the spending data. And it's getting hard to assess where the ultimate trend is. And especially if we get these tariffs that come on in force and they stay on, those stagflationary forces that we talked about earlier would come even more into play. So I think we have to pay close attention to the policy developments, be nimble, and watch kind of the negotiations that'll take place if those come on. Now, for the Fed, I think it is a challenging environment. I think if you go back again a few weeks ago, Fed was in no rush to remove accommodation, U.S. economy on solid footing, inflation gradually moving down, but with that risk of Trump tariffs looming large and the potential for the stagflationary effects of that. So if those come into play, they have a difficult balancing act to face. And I think it's going to depend on what they're seeing in the data and the size of the tariffs and what they think the effects are. But ultimately, I would think if we got broad-based tariffs and you had a big negative growth shock, I would expect the Fed to be cutting in that environment. But it's a lot to be seen.
Sure. There are too many moving parts. Very hard to sort of model any of this. So kudos to you. Just a final question from my side. China. Now their big, much-awaited March parliamentary meeting is kicking off today. What are your expectations and what is your assessment of the economy? Everything that they've done throughout 2024, is it adding to anything realistically on ground? And would you expect a bigger stimulus to also ward off tariffs plus their own local slowdown issues?
Yeah, absolutely. And China faces an array of challenges on top of the US-China tensions and the tariff risks and the tariffs that have gone on, other sort of internal deep structural issues, unwinding property sector, aging demographics, high youth unemployment, and those structural factors and headwinds are likely weighing on consumer confidence and spending today. And so you've seen relatively tepid performance from the consumer. Our base case going into this year has been that growth in China would slow from 5% last year to 4.2%. That has an assumption of 10 to 15 point increase in tariffs from the US administration, those staying on, so the durable increase. So far, we've seen 10, could go up to 20,
Right.
and maybe more could come after that. So that could create headwinds, but the authorities in China could also come out with more stimulus to help offset that. So I think we have to watch both the U.S. space closely for the tariffs and how the Chinese authorities respond. Right now, we're sticking with that fairly decent growth forecast of somewhere in the low 4% range, but it'll depend on, I think, on those two factors. How the Chinese government responds, particularly for the consumer, to help offset some of those issues I mentioned and the tariff risk, and how large tariffs end up actually being on China and whether those stick.
All right, Robert, we'll leave it there. Very interesting conversation. Thank you for joining us. I'm assuming it's a late hour for you. So good night to you. And as we start our morning, thank you indeed for your time. So